So thank you to everyone who's joined us. And thank you for joining the Center for Financial Security for How Are Older Adults Affected by Debt Stress and Mortgage Borrowing, a webinar presentation of study findings and implications. My name is Hallie Leinhardt. I am the Assistant Director of the Center for Financial Security here at the University of Wisconsin-Madison. And just to give a bit of a rundown on our format for the webinar today, we will start with the research presentations, so some background, methodology, and findings, and then we'll move into discussions of study implications with experts from the Urban Institute and Congressional Budget Office. We will then continue with a question and answer session, so please feel free to submit questions in the chat box at the bottom right side of your screen throughout the webinar. I'm very excited to introduce our presenters for today's webinar. Stephanie Moulton will be presenting on research that she and her team at The Ohio State conducted under the Center for Financial Security's Retirement and Disability Research Center. Stephanie is an associate professor and director of doctoral studies at the John Glenn College of Public Affairs. Laurie Goodman is the Center Director of the Housing Finance Policy Center at the Urban Institute, and Laurie has joined us as a discussant today. And Nadia Karamcheva, she is an economist with the Congressional Budget Office, and Nadia has also joined us as a discussant today. So thank you all for being here. And with that, I'm going to go ahead and turn it over to Stephanie Moulton. If you'll just give me 1 second, Stephanie, I will cue you up.
All right. Looks like I'm able to take control now, perhaps. Let's see. Oh. So it's not letting me progress. Let's see if I can do it this way. Great. All right. So thank you for joining us here today. My name is Stephanie Moulton. I'm an associate professor at Ohio State University, and my co-authors on this are also on the phone. We have Don Haran, who is Department of Economics at Ohio State University, and then Cecilia Leubel with the Department of Human Sciences here at Ohio State University. And so we'll be answering some questions for you afterwards. But this was a project that we were very excited to have funding from Center for Financial Security through the Social Security Administration's Retirement Research Collaborative. But as with all research, this research represents our opinions and not those of the U.S. government or the Social Security Administration. We also were pleased to receive some funding for prior work through the U.S. Department of Housing and Urban Development and the MacArthur Foundation that formed the basis for some of the data that we use here. But again, these are our insights and not those of our funders. So with that, I'll just go ahead and get started. So many of you have probably heard or seen headlines about the rising levels of debt among older adults. And indeed, you know, if you look at something like the Survey of Consumer Finance, this is the proportion of households that have any debt over the age of 65. And you can see that, you know, this has increased from about 40% of households in 1989. Today in 2016, or I guess today is 2019, but in the most recent wave of the SCF in 2016, it was about 65% of homeowners over the age of 65 had some type of debt. And then if we break this down by type of debt, you also see, well, first I'll show you by age cohort. So, you know, while debt is increasing, this is nuanced by age cohort. So, yes, the debt is rising, but there's some differences. So the younger, older folks, if we look at folks that are just entering the retirement years, for example, age 50 to 51, that's the blue line that you see. This is using data from the Health and Retirement Study. And you see that the percent with that is holding about the same. It increased slightly during the crisis, and then it's back down to be about the same among that age cohort from 2004 to 2014. We're looking at a slightly different time period here. It's a bit of a shorter period. So just looking at the second half of what I was looking at in the prior graph. But then if we look at the age group, age 62 to 71, you see that increase. So you do see that we've increased from 47% to 55% holding debt. And then if we look at older adults, again, that red line, it also shows that increase. So there's some evidence that the proportion holding debt is increasing in retirement. And, you know, we would say this isn't necessarily concerning, but you want to look at how their debt to asset ratio. So it could be that debt's increasing, but assets are also increasing. But in fact, what we see is the ratio of the total amount of debt that they hold to total assets has also been increasing over time. You can see that's particularly true for the younger generation, the 50 to 61-year-olds, but that's true for really, there's a slight increase among all generations. So at the very least, it's not being offset by an increase in assets. So that, and then also if we look at what type of debt is increasing, mortgage debt is really the driving type of debt that's increasing among this population. And so this is just the increase in the amount and proportion of individuals holding mortgage debt over time. So the bars are showing you the amount, and the lines are showing you the percent with mortgage debt. So, if we look again among the youngest cohort, the blue, it's looking pretty flat in terms of the percent. But if we look at the green line or the red line, you do see that the share holding mortgage debt has also been increasing over time. So this is kind of motivating our inquiry into understanding how does debt affect kind of overall financial well-being in retirement. And here we're going to look specifically at the amount of stress that individuals experience from debt. And, another piece of our motivation, and I think an important piece of this framing, is that it doesn't necessarily mean the sky is falling. So debt isn't inherently good or bad. It's a form of liquidity. And so it's not necessarily the case that just because we see debt rising that means that there's, going to necessarily be an increase in stress. And, for example, there's been prior research that has shown that, borrowing through a credit card is actually the primary source of consumption smoothing for most U.S. households. And in fact, older adults hold credit cards and use credit cards. So the same study found that about 85% of adults age 65 and older hold a credit card. And then if we look at those age 70 and older that have a credit card, about 45% were not paying off their balance in full each month, which demonstrates that they're having some kind of need for liquidity that's being met through the use of a credit card. So while we think it's not good or bad, it's possible, though, it could increase psychological stress, and there has been some research that has linked debt with increased stress. Some of that research has actually come out of some folks here, not on our team, but at OSU. And they also find that, that the amount of stress that you experience varies by type of debt. So the type of debt that's associated with the largest amount of stress has been the non-collateralized consumer debt. So think about credit card debt, but they also include in that payday loans and other types of non-collateralized debt. Whereas, auto loans are collateralized debt, which have less stress, but actually the smallest amount of stress was found for mortgage debt. So while increasing mortgage debt has been associated with stress, it was less than what you would see for credit card debt in prior research. So we want to look at that among older adults specifically, because that hasn't been examined before. And then also think about reverse mortgages. So reverse mortgages, as you may know, are a unique type of debt that are available only to older adults age 62 and older. The predominant type of reverse mortgage here in the U.S. is the federally insured home equity conversion mortgage, or HECM. And with the reverse mortgage, the borrowers are able to receive cash from the home but have no required payments until the last borrower leaves the home or the loan is terminated because they no longer meet the obligations of the loan. And so essentially the money that they get from the loan plus anything associated interest and fees are added to the balance. And so the balance grows over time, and that's why it's considered a reverse mortgage. It's growing in reverse. And so because they have no monthly payment and so there's no required repayment of the mortgage until the end, it's possible that reverse mortgage debt is associated with less stress than forward mortgage debt. And this could be kind of similar to if you think about like debt illusion. You actually hold the same amount of debt, but because you have no required obligations on that, you're not seeing it, it actually, it's not creating as much stress. So to look at these, and the last thing we look at, so it's not just about stress, we also want to see is this affecting retirement decisions. So there's been some research, and actually by one of the discussants here on the call, that has linked increased debt with a lower probability of claiming Social Security benefits, and actually a higher probability of remaining in the workforce. And so the idea here is that servicing debts, making monthly payments on debts, may increase an incentive to remain at work and delay the claiming of benefits. However, there's also research that suggests that changes in house value have been associated, so appreciations in house value have been associated with delayed Social Security claiming, particularly during the housing boom. So it's possible that this was in part due to increased liquidation of home equity through mortgage borrowing. So again, our expectations regarding the implications for retirement behavior are somewhat unclear, although we would expect to also find that it would delay claiming early benefits at the age of 62. Let's see here. All right, so we have 3 research questions that we're tackling in this study, and each of the questions has slightly different analysis approach. So I'm going to share with you the approach and the findings for each of these questions separately. So the first question is whether or not debt increases psychological stress for older adults. So prior studies have documented this among younger cohorts. We want to see if that exists for older adults, and then we want to see if that varies by type of debt. Then the second question, we're going to look specifically at reverse mortgage debt and see whether or not reverse mortgage debt is associated with more or less stress than typical forward mortgage debt. And then our third question is going to look at the relationship between debt and debt stress, and then older adults' decisions regarding whether or not they claim Social Security benefits early, which we define here as at the age of first eligibility, which would be the age of 62. All right, so for the first mortgage question, or sorry, for the first research question, we're relating debt and financial stress. We used the Health and Retirement Study, and we used the waves in 2004 to 2014. So for those of you that might be familiar with the Health and Retirement Study, there are 2 questions that ask about debt stress types of constructs that begin in 2006. And so we can't really go back much further than 2006 because we don't have those outcome indicators prior to 2006. And the 2 indicators that we look at, the first one is an indicator about ongoing financial strain. So this is asking whether or not the individual has experienced ongoing financial strain. And the second question is more of a material hardship question, and it's asking whether or not the person has difficulty paying their bills. For the purpose of today, I'm going to focus on the ongoing financial strain, but in our full report, which will be available on the website through the Center for Financial Security, you'll be able to look at both of those 2 outcomes. And in general, the results are pretty similar, regardless of whether you use ongoing financial strain or difficulty paying bills, with some nuance. And so how do we estimate this? So we take advantage of the fact that the Health and Retirement Study is a panel data set, which lets us see the same person over time. So we can actually see that same person in 2004 and then see him again in 2 more waves in 2006 and 2008 and so on. And so what we do is we look at essentially their financial stress as an outcome as measured by a variety of predictor variables, including your non-housing debt balances, your housing debt balances, your income, which we break into different types of income, your financial assets, as well as a vector of household and individual controls. And the panel data allows us to think about these things, kind of break the contemporaneous nature of the debt that you hold and the stress that you feel. So we actually lag our amounts of debt by one wave. So we're looking at debt held in a prior wave, so let's say debt held in 2006, and how that might be affecting your stress in 2008. Because we know that these 2 things can be very related. So all of our financial variables are lagged 1 wave. All right. And so just before I show you the results, this is the question about ongoing financial strain, and it's asking individuals if they experienced any ongoing financial strain. And you can see that about 65% said no, it didn't happen. But then we have another proportion of individuals, 35%, who say they experienced some financial strain, and it varies in the extent to which it's upsetting to them. So we're exploiting this fact when we do our analyses. We treat this ongoing financial strain both as a continuous variable, where we let these categories kind of be mutually ordinal, and then we also treat it as a binary variable, dummy variable, where we say, did you have any financial strain, yes or no? But the results I'm presenting today are going to be those that use the full data. So here you can see whether or not financial strain is simply correlated with the amount of debt that you have. And we can say, yeah, it is. So if you look at those who say they have financial strain, that's the left set of bars, you can see that those who say they experience financial strain have higher debt levels on average than those who say they do not experience financial strain. So if we look at credit card debt, you're looking at people that say they have financial strain have almost $2,000 in credit card debt. compared to, just over 600 for those who do not. Mortgage debt, 24,920 compared to about 14,000. And then other types of debt, about 1,100 compared to 642. All right, and so what do our results show? So very similar to some prior research, we show that credit card debt is actually associated with the highest amount of stress of any of the different types of debt, and that mortgage debt is actually associated with, is still associated with stress, but less so than credit card debt. And then you can see that the other financial debt is also associated with stress. And I'm having trouble seeing my little box under here, but it's like $10,000 in mortgage debt is equal to about $640 in credit card debt with regard to the amount of stress that it's associated with. All right. The question, too, that we look at is then looking at reverse mortgage debt. So now we want to really drill down and see whether or not reverse mortgage debt is associated with more or less financial stress. And reverse mortgages are currently asked about in the health and retirement study. However, only about 100 individuals in the health and retirement study report having a reverse mortgage. And so we actually end up relying on our own data of individuals who were counseled for a reverse mortgage. We look at, these are individuals that were counseled for a reverse mortgage between 2010 and 2011, and then we go back and we look at our survey of these individuals in 2014 and 2015. So we're going to actually administer a survey to individuals who were considering a reverse mortgage in 2010 and 2011 that is going to include questions similar to those that are included on the health and retirement study, asking them about their debt stress in addition to other indicators. And the nice thing about our survey data is that we have individuals who are counseled for a reverse mortgage in 2010 and 11, and about 70% of them went on to get a reverse mortgage, but about 30% did not. And our survey actually surveys both of those groups. And so we have people who were, both of whom, were considering reverse mortgages, but some got and some did not get a reverse mortgage. So this allows us in some ways to also estimate a treatment effect of getting a reverse mortgage on subsequent stress that you might experience. And so for those of you familiar with kind of treatment effects models, we treat the getting a reverse mortgage as endogenous, as a decision, and we model that decision using some policy variables that changed over time that will affect whether a person gets a reverse mortgage or not. And then we also include the different financial characteristics like the amount of debt that they hold, the assets that they have, their income, and we treat those financial variables also as endogenous in this model. All right, so what do we find here? We actually find a couple of things that I think are interesting. So overall, getting a reverse mortgage in general is associated with a reduction in stress. So that endogenous treatment variable that we model is associated with a significant reduction in debt stress. However, reverse mortgage debt is still associated with an increase in stress. A $10,000 increase in stress increases the debt stress score by about 0.02, but that's smaller than what we see for forward mortgage debt. So forward mortgage debt actually is associated with a larger increase in debt than as reverse mortgage debt. So that's very similar to what we had kind of hypothesized might happen if there was some kind of debt illusion. But to help kind of interpret this effect, we provide kind of a stylistic example here. So if you consider an older adult who in 2010 has a $200,000 home and they had $100,000 in forward mortgage debt and $10,000 in non-housing debt, if that adult originates a reverse mortgage, they have to pay off that current mortgage balance of $100,000 with the reverse. So they're no longer going to have that balance. And they also decide that they're going to pay off the $10,000 in consumer debt, and they pay $6,000 in fees and closing costs. So their new balance on that reverse mortgage is $116,000. And it's going to grow each year at 7%. So by 2014, it's going to be about $152,000. So then we can estimate, well, how much debt stress might that person experience in 2014? And you can see if they decide not to take a HECM, their forward mortgage balance plus their consumer debt is going to be associated with about a half a point or 0.45 unit increase in debt stress. But for those who actually originate the reverse mortgage, at least in 2014, they actually have lower debt stress than somebody who did not take out the reverse mortgage. You can see that their debt stress actually is associated with a decrease by about 0.05 units. If we were to assume that this was kind of a linear effect that persists over time, there is a tipping point at which the amount of stress that you would have from HECM debt could actually fully offset the HECM treatment effect, meaning that a person could actually experience stress from the reverse mortgage debt because the balance is growing over time. So really, the amount of stress you experience from a reverse mortgage is a function in part of how the debt is used, if it's used to pay off forward debt or used to pay off credit card debt, and then also how that balance grows over time. The last thing that we look at is using the health and retirement study data again, and we look at how debt stress is associated with your early claiming from Social Security retirement benefits. And here we limit the sample to older adults who turned age 62 in 2008 through 2014. And we use those same two indicators of debt stress to predict whether or not, or financial stress, to predict whether or not they're going to claim Social Security early. And so prior studies have looked at simply having debt and then observed that that is associated with delayed claiming. But we think that there could be some idiosyncratic component of debt that might be exhibited by the amount of stress that you feel that could be associated with your claiming behavior. And so what we observed for this analysis is that, in fact, financial strain is, and this is the results for financial strain, we observed similar results if we look at difficulty paying bills. But financial strain is associated with a reduced probability of about 7 percentage points of claiming Social Security early. The average respondent in our sample, about 44% of individuals claim Social Security at the age of 62. So if they're experiencing financial strain, they're less likely to claim benefits early. We aren't modeling staying in the workforce here. This is more of a reduced form estimate of claiming Social Security early, but one assumption could be that they're staying in the workforce and not claiming. And you do see that if they had no earnings at age 60, they're much more likely to claim early. So 13 percentage points more likely to claim early if they had no earnings at age 60. Interestingly, after, and actually even without accounting for financial strain, we don't find that debt levels by themselves are associated with the change in probability of early claiming. We find that it's really the financial strain that seems to be associated with the early claiming. There's also an interaction effect that we observe with your respondent earnings. I'm actually going to show the difficulty paying bills in the essence of time here. But basically what you see here is that as a person has more money at age 60, they're actually less likely to claim Social Security benefits early at age 62. And this is kind of a known fact that as your earned income or your earnings is higher, you're less likely to claim Social Security early. However, this is actually moderated, or you could say attenuated by whether or not they're having difficulty paying their bills. So individuals that are having difficulty paying their bills are much less likely to claim early, that's the red line, than those who are not having difficulty paying their bills, that's the blue line. So it's not simply being in the labor force in the prior period that appears to be associated with early claiming. It's actually attenuated to some extent by whether or not the person is having difficulty paying bills, and if they are, that might keep them from claiming benefits early. So just kind of a high-level discussion of our findings. We find that mortgage debt is associated with less stress than other types of non-collateralized debt. We find that reverse mortgage debt is also associated with less stress than forward mortgage debt, which might provide some evidence of a debt illusion. However, we've got to remember that reverse mortgage debt does grow over time, and thus stress can grow over time, while forward mortgage debt is declining over time. We do see that financial strain, measured as financial strain or difficulty paying bills, is associated with a reduced probability of claiming Social Security benefits early at the age of 62. However, financial strain actually, for those that have higher levels of earned income in the prior period or had difficulty paying bills in the prior period, you see an even greater effect of this financial strain on delayed claiming. And then finally, the effects of reverse mortgages on stress and early claiming really depend on how the reverse mortgage proceeds are used. So because we observe this relationship between other types of debt, like credit card debt and financial stress, if reverse mortgages are used to pay down this more stressful debt, then we would expect them to be associated with less stress. And, in fact, we know from our prior research that paying off mortgage debt and paying off other consumer debt are actually two of the top 3 primary reasons that older adults seek reverse mortgages. So actually 39% say they seek reverse mortgages to pay off mortgage debt, and in fact, about 60% actually end up using some of the proceeds to pay off the mortgage debt. But about 40% of them got a reverse mortgage for that reason. 26% say they seek it to pay off other consumer debt, and about 14% seek reverse mortgages for health and disability expenses. So only 6% report seeking reverse mortgages for that big purchase or vacation, like you might see on TV. So that's our kind of discussion of our paper, and we look forward to hearing feedback from the discussants as well as those of you on the phone to your questions and comments. Thanks.
Well, thank you. This is Laurie Goodman. Thank you very much for having me on, and thanks very much for the opportunity to discuss this very interesting paper. I'm having trouble advancing. Okay, great. There hasn't been much research on the topic of debt and financial stress in the older population, and this paper looks to fill the gap by measuring stress as both material hardship, that is difficulty in paying bills, and psychological hardship. It's a particularly important topic given both the aging of the population and the increase in the amount of debt held by older adults, which Stephanie did such a good job quantifying. So in my comments, I'm going to address the first 2 research questions. First, does debt increase psychological stress for older adults, and how does it vary by type of debt? And then the second one, does reverse mortgage debt create more or less strain than forward mortgage debt? I actually found the results in this paper both very interesting and, more important, and very intuitive. So the purpose of my comments is actually going to be to share my intuition for the results and to suggest avenues for further research. So we're going to start with part 1. I guess one of and their first conclusion, Stephanie's first and co-author's first conclusion was mortgage debt is the debt that produces the most stress. And my first reaction was, well, of course, because the question is it debt itself that produces stress, or is it the monthly payments from that debt? And credit cards have much, much higher monthly payments per $10,000 outstanding than other types of debt. So, you can see, so Stephanie showed the second column, the financial strain coefficients, but I've actually showed both sets of coefficients. They're very similar by and large. And in both cases, credit card balances are by far the most stressful type of debt. Well, they're also the highest payment. So I did approximate interest rates by just sort of Googling around and then looking at both interest rate and term. So in credit card debt, I just assumed an average interest rate of 20%. In many cases, it's higher. You have to make a 4% minimum payment each month, which gives you a payment of around $400 per $10,000. And again, in many cases, the rate's even higher. Other financial debt encompasses auto debt, personal loans. It's a conglomeration of things. I use 10% and a 5-year amortization schedule, giving you payments of $212 a month. First mortgage balance, 4% rate, a 30-year amortization schedule, $48 a month per $10,000. HELOC, 5.5%. The $82 assumes a 15-year amortization. If you're in your draw period, you don't have to. It doesn't amortize, so the amount may be as low as $33 per $10,000. And second mortgage balance is about 6.6% interest rate, $88 a month. So credit card debt is the debt that has by far the highest payment per dollar of debt. So if you look at this, if you look at the effect per dollar of debt service, which the data doesn't allow you to do, the differentials by debt type would have been much, much smaller. And secondly, there's some endogeneity in these variables. So for example, cash out refinancings offer an opportunity for borrowers to consolidate debt from their credit cards and other financial debt into their first mortgage. And those in a better financial situation are more apt to take advantage of this. And that is, but to do so, you need a high credit score, which they can't explicitly measure. So the net impact would be to lower the coefficient on mortgage strain and raise it on credit card and other debt. And we'll talk more about this endogeneity issue a little bit later. But, again, the fact that credit card debt is debt that produces the most stress is a totally intuitive result. The second thing I want to point out is that HELOC balances are actually the debt that produces the least stress. And this is because HELOCs are the borrowers who are in the best financial shape of all. They generally tend to have the highest credit score and the greatest wealth. HELOC, for example, the average net worth of HELOC borrowers, according to the Survey of Consumer Finance, is about $561,000 versus $142,000 for cash-out refinancings and second and third mortgages. The income of HELOC borrowers is about $74,000 versus $39,000 for cash-out refinancings and $47,000 for second and third mortgage holders. In addition, HELOC borrowers have the highest credit score on average. It's close to around 780 on new HELOC borrowers. So, Stephanie and her co-authors were able to capture wealth and income. They were not able to capture credit score in their analysis. So, again, it's no surprise that, HELOC borrowers who are by far the most affluent experience the least financial stress per dollar. Then Stephanie didn't discuss this set of results in her formal presentation, but I actually thought it was very, very interesting. She looked at increases in mortgage debt after age 62 versus decreases in mortgage debt. So a $10,000 increase in mortgage balance after age 62 is associated with a 0.14 increase in reported bill paying difficulties, but it's not significantly associated with the level of financial strain. By contrast, a decrease in mortgage debt is associated with decreases in bill paying difficulties and financial strain. And mortgage and debt carried into retirement is associated with an increase in financial strain, whereas new mortgage debt after age 62 is not. That is, new debt is asymmetric relative to decreases in debt. That is, new debt doesn't impose a financial burden. And this is actually a very intuitive result because cash out refis and other equity takeouts can account for this. So part of the increased debt level is accounted for by borrowers who did some sort of an equity takeout. Those who take advantage of this generally have a home which has appreciated as well as a good credit score, which would allow for the pay down of credit card and other debts, exactly similar to the point that Stephanie made for HECMs. So it'd be very interesting to include an interaction term for those who have both an increased mortgage debt and paid down credit card debt to try to account for this, because you can see the coefficients on credit card debt are very, very high relative to the coefficients on the mortgage balances. And again, increasing your mortgage balances to pay down credit card debt should decrease financial stress, as she shows it does. But again, you need a high credit score to take advantage of it, so there's some endogeneity. And equity takeouts, actually, it's not. This actually shows you the share of homeowners 65 and older who extracted home equity by strategy. You can see HELOCs are the biggest form of equity takeout, followed by cash out refinancing. So again, two biggest forms of equity takeout, HELOCs and cash out refinancing. And in fact, if you look at the right-hand side of this page, you can see that 70% of those who did a refinancing actually took cash out in early 2019. 70% of all refinancings involved cash out, involved some amount of takeout, which is just a staggering number. A few other comments. It would have been interesting to separate out renters from homeowners and observe whether the coefficients are different between the two groups. The paper currently assumes that renters have $0 in mortgage debt and homeowners have $0 in rental expenses. So this may actually bias the stress numbers down a bit on mortgage debt, as renters generally have more financial instability. And the authors have attempted to control for this, but again, you can't capture credit scores and other credit variables due to data limitations. Again, looking at some sort of interaction terms in the two sets of regressions to try to handle the endogeneity issue, I think would be very, very useful. But I just, again, I loved this paper. So these are more in terms of, enhancements, things that you can do going forward. The reverse mortgage results were just fascinating. So first, I love the fact that they use survey data for those that received counseling in 2010, 2011, and then replied to a survey in 2014, 2015, because you basically got borrowers who took out reverse mortgages and those that didn't, and then were able to compare how they did 4 years later. The analysis in this uses a two-stage estimation procedure, which takes into account the decision to take out a reverse mortgage is endogenous. They find, using the 4-year postmortem survey, that the reverse mortgage initially reduces stress, that there's a very significant HECM treatment effect, and the stress contribution of HECM debt is lower than first mortgage debt and much lower than consumer debt. And this of course makes sense, as Stephanie pointed out. You're relieving yourself of a lot of current monthly payments. The question is, what happens over time? And the authors hypothesize that the HECM may cause additional stress over time. They argue clearly the HECM balances grow due to interest in mortgage insurance costs while the forward mortgages are repaid. But I think this dynamic statement is very, very hard to make, because the HECM borrower doesn't have to make the forward mortgage payment each month, which would allow for more residual income, which can be used to make their lives more comfortable. And it provides less of an incentive to incur credit card and other consumer debt. So I think, so it could be that, the coefficient, so I would argue that the coefficients are not apt to be constant over time. On the other hand, once the borrower has extracted their home equity, they may not get a second shot at it. So, So I think it's just very, very hard to argue what happens over time, because there are just a lot of different effects, and trying to extrapolate a forever from a 4-year postmortem survey is very difficult. It might actually be interesting to survey these the same borrowers in another 4 years, as and just see what it looks like if that's possible. But again, I want to thank the authors for just a great paper, and thanks very much for letting me participate.
So this is Nadia Karamcheva from the Congressional Budget Office. I'm very excited to be taking part in this webinar. Stephanie and her co-authors have written a very interesting paper, and I'm happy to be able to comment on it. So before I get started, I just want to make it explicit that the opinions that I'm going to present in the presentation are my own, and they should not be interpreted as the views of the Congressional Budget Office. So as Stephanie pointed out, there are 3 main research questions that she and her co-authors examined in this paper. And since Laurie talked quite extensively about the first 2, what I'm going to do is just focus on the third one. And the third question had to do with whether financial stress affects retirement decisions, such as timing of claiming Social Security benefits. And I want to start by giving you a little bit of background and just putting the question in the broader context. So similarly to what Stephanie showed, so this is data from the Survey of Consumer Finances, what has been well documented already is that there is a considerable increase in household debt for individuals approaching retirement age. So both the share of households that have debt and then the median values of debt has increased over time. At the same time, another well-documented fact has been that employment rates and labor force participation of people in their 60s have also increased over time. And this is true for both men and women. So this chart here is based on the data from the current population survey between the years of 1990 and 2018. So in addition to that, we have also seen that claiming at age 62 has become somewhat less prevalent today. So again, looking at data first from the 1990s and then more recently from the early 2010s, we see that the share of individuals that claim at 62 has declined for both men and women. However, still today about a third, 30% of men and 33% of women still do claim their Social Security benefits as early as possible at age 62. So why is that important? Why is the timing of Social Security claiming important? Well, one can start his or her benefits as early as age 62, known as the early eligibility age, but doing so would mean that the person's benefits will be actuarially permanently reduced for life. So the retirement age, or the age at which a person is entitled to what Social Security calls their full retirement benefits, has been increasing over time, and that is due to legislative changes in the early 1980s. So that age has increased from 65 for somebody born before 1937. Today it's 66 and 2 months, and for people born in 1960 and later, it's going to be 67 years of age. So that is important because of these scheduled increases in the full retirement age, the benefit at age 62 as a percent of a person's full benefit has been declining over time. So for example, from 80% for those born before 1937, and for people born in 1960 or later, they're going to receive 70% of their full benefit were they to claim at age 62. So just to summarize, so there are three trends that have been well documented and I think are very relevant for this paper. So the first one has to do with rising debt at older ages, and then also the fact that older adults have been working longer and claiming later. And there's quite an extensive literature that has looked at possible explanations for this increased employment and delayed claiming. And I'm listing some of the factors here that have been examined already. More recently, in some work that I did with Barbara Butrica at the Urban Institute, we also examined the relationship between household debt and increased employment and delayed claiming. And we did find that indeed households that are more indebted are the ones that are more likely to delay claiming their benefits and in general retire later. So this is where the current study fits in. So the author's work suggests that maybe financial stress might be one of the contributing factors. And more so, it makes me wonder, actually, is it debt or is it just debt that causes financial stress that actually affects claiming behavior? And it's probably not even necessary to explain explicitly why this is important, but obviously changes in labor supply or benefit claiming can affect federal spending and tax revenues, and in turn can have significant effects on the federal budget overall and on the Social Security finances in particular. So just to go back to the paper, and Stephanie explained this in quite a bit of detail. So in general, they do find quite a bit of prevalence of financial strain among older adults, which declines with age, and except for a considerable increase around the Great Recession, has remained relatively flat since then. In general, the authors find that credit card debt has the largest association with financial stress, while mortgage debt has positive but smaller association. And in terms of its effect on claiming, what the authors found is that experiencing financial strain at age 60 results in about 7 percentage points lower probability of claiming at 62, while difficulty paying bills at age 60 results in about 12 percentage points lower probability of claiming at 62. What is interesting is that the authors do not find any separate effects of the level of debt. So here are some thoughts and suggestions that I had. So in general, I find that the paper has a great number of very interesting descriptive results, and I would like to encourage the authors to explore that a little bit further and examine in more detail the associations between financial stress on one hand and then debt and claiming on the other hand. And I would pose the question, well, does the presence and level of debt matter at all, or is it just financial stress that matters in claiming behavior? So in other words, is it only when debt causes stress that individuals change their claiming behavior? And in the specifications that the authors have, I guess that could be addressed by controlling for these two factors separately, and then maybe also adding interaction terms between debt and stress. And similarly, it made me also wonder whether leverage matters. And by leverage here, I mean the ratio of debt to assets or the ratio of debt to income, for example, for a given household. And Stephanie did show early in her presentation that those ratios or the leverage numbers have been increasing over time in the health and retirement study as well. So again, what would be interesting for me to find out is whether the level of indebtedness or how leveraged the household is, does that impact behavior at all, or is it just the stress that it causes? And also, how about different types of debt? So the authors already do examine in quite a bit of detail the effect of credit card debt versus mortgages separately. However, what I found particularly interesting looking at the data from the Survey of Consumer Finances in a recent paper is that student loan debt seems to have increased quite considerably for older households as well. So this is data from the Survey of Consumer Finances for households between ages 55 to 70. And particularly after 2007, we see quite a bit of an increase in median student loan debt for those households. So my hypothesis would be that student loan debt might be more stressful than mortgage debt, even if not as much as credit card debt. So I realize that this kind of analysis might not be possible with the health and retirement study if student loan debt is not separated, but it would be perhaps an interesting avenue for future research. And another suggestion that I want to make is more methodological. This figure here shows the distribution of claiming ages of new retired worker beneficiaries in 2018. And we see that while a considerable share claim at age 62, many people claim at ages older than 62, but still younger than their full retirement age. So claiming in general before a person reaches their full retirement age would be considered early claiming and would result in reduced benefits. So I would encourage the authors to use the longitudinal nature of the data to analyze the timing until initial claiming. And that's going to allow them to come up with estimates, for example, for what is the average length of delay. And the reason I think this would be important to model is because I have found evidence of this in other work using the health and retirement study. So for example, what this graph is showing is the share of individuals that haven't yet claimed their benefits by ages between 62 and 69. So this line represents households with individuals without debt, and the dark line represents individuals with debt. So what we see is that those who have debt delay claiming between ages 62 all the way through reaching their full retirement age. So just a couple of other small suggestions. So in the specifications, the authors might want to control for other factors that affect the timing or benefit claiming, and those have to do with spousal interactions. So, for example, whether a spouse has already claimed their benefits or has retired. And the authors also might want to control a little bit better for who is eligible for Social Security, although they already do quite a bit of that in the analysis. But one example would be to use information on total years of worked in a lifetime to better get a proxy for who has Social Security coverage. And I also want to point out that sometimes the continuous measures of financial strain were a bit hard to interpret. So I would suggest maybe presenting a bit more results with the binary measures. And in conclusion, I just want to highlight that I thought that the paper was very interesting. It's very timely and relevant. I really appreciated being given the opportunity to review it. So in general, the paper pushes us to consider what types of debt cause financial stress and whether financial stress is one of the factors encouraging people to delay claiming. And as the authors continue to push this question forward, I would suggest that they continue to disentangle the effects of financial stress from that of indebtedness. And I'm very much looking forward to following the authors' work in the future. Thank you.
Thank you very much. Thank you to all the presenters for your excellent presentations. And we do have some time for questions from the audience. So with that, I'm going to go ahead and move into a few questions. I'm going to start with one that I'll direct towards the Ohio researchers, Stephanie, Cecilia, and Donald. And this is just a question that I know that we have a lot of practitioners, a lot of people who work directly with clients. And so some people are wondering if you can talk a little bit more, Stephanie, about the measures that were used to determine the financial and psychological stress, whether those be scales or how is that actually kind of pulled out from those people who were involved in these studies?
Yeah, so absolutely. There are, in the HRS, there is a leave behind supplement, which is something that people respond to every 4 years. And there were 2 questions that we used. So for the psychological stress, we're using a financial strain indicator, and it's part of an index of stress that individuals feel from a variety of different things. So financial strain is just one of the sources of stress people could be feeling. So it's a psychological measure, and it asks whether or not they experienced financial strain in the prior 12 months. And it's on a scale of 1 to 5, I believe, where 1 is that you didn't experience any financial strain. It's actually called ongoing financial strain. So did you experience ongoing financial strain? And 1 is none. And then there 2, 3, and 4 were, based on how much financial strain you experienced. And the other one was difficulty paying bills. And Cecilia, I don't know if you're on the phone, you may remember what the scale was for difficulty paying bills. I believe it's also 1 through 4, but she can clarify if she's on.
Yes, I'm here. The scale was 1 to 5
yeah, I think it's
for
4,
difficulty
and 1
paying
being no
bills,
yeah.
and 1 to 4 for the ongoing financial strain.
Okay, great.
Very good. Thank you for that clarification. And now I have a question that is around the reverse mortgage topic of this paper. And so it seems that reverse mortgages are, based on what you presented, they're not all that common. It's not something that is taken up all that much. The percentage of mortgages are not largely reverse mortgages. But so from this paper, we're seeing that the stress is less with reverse mortgages. So I'm wondering, or this person is wondering from the audience, whether this is some indication, based on the fact that you have studied this and the findings, is there some indication that this type of mortgage is going to become more popular? Is there going to be greater take-up of reverse mortgages? And I'm going to first shoot this question over to Laurie from the Housing Finance Policy Center at Urban, but then feel free to step in with any other information, Stephanie and Ohio researchers as well.
Yeah, so I think you're going to actually reverse mortgages will become more common for 2 reasons. The first is the growth of the senior population, which is going to go from 22% in 2016 to an estimated 30% by 2030. So you have kind of more seniors, most of whom are less well set up for their retirement than the previous generation of seniors. In addition, as Stephanie pointed out in her presentation, as I had in my very last slide that I did not cover, more of these seniors have forward mortgages. And, and as Stephanie pointed out, paying off the forward mortgage is the number 1 reason for taking out a reverse mortgage. So as an increasing number of the younger folks age into seniorship and have mortgages, there's going to be a far greater demand for this. So this is just a hugely important program.
Yeah, and I'll just agree with what Laurie said and add one more thing. But I think one of the things what we learned early on in our research was that the majority of people are getting reverse mortgage to pay off forward mortgage debt. And I think that wasn't understood previously. I think, the kind of the way we think about reverse mortgages is that they're annuities, when in fact, very few people are using them as annuities. Like we're talking less than I think it's around 6% of people actually structure them that way. And really, a lot of people are using reverse mortgages to pay off debt. So exactly what Laurie said, as those trends are changing and people carrying debt into retirement, this could become more important. But another thing, that kind of motivated our question into this, exactly, reverse mortgage rates have been low. And so if reverse mortgages were creating stress, then that could help explain why the rates are lower than we would expect. So, they do create some stress relative to somebody that had absolutely no debt before. Taking out a reverse mortgage, the debt amount that's held could create, some stress, particularly over time. And so, and if it's not being used to pay off other debt. So, that I think it can go both ways, perhaps. But
actually, I have a question that just kind of piggybacks on what you mentioned, and I'm glad that you brought that up about the annuity not being the popular form, because I think that might be a misconception. And in fact, we had a question about that really didn't show up in the data that you presented as to the reasons why people are taking reverse mortgages, which is aging in place. Can you speak to that at all? I think that's something that a lot of people kind of might associate with a reverse mortgage, is this reason of staying in the home and then basically living your final years there. Can you speak to that, Stephanie, Laurie, after that?
Yeah, I think survey research shows that individuals that are older want to age in their home, and so that would explain why, you would think people would be looking at options like reverse mortgages. So in one hand, it's kind of surprising that the take-up rate has been so low over time than what we observe. But I definitely, in the survey data, of the people that get reverse mortgages, certainly a desire to stay in their home is part of that motivation. And there has been a Freddie Mac survey that Laurie might be able to speak to a little bit as well that talked about individuals' motivations for aging in place.
Yeah, aging in place is obviously very important to most people. And, I think, one thing that didn't really come out so much in this paper because it wasn't the primary purpose, but in, previous work that Stephanie and Don have done is, you look at the reverse mortgage borrowers, and these are the people that are the least financially able to age in place. They are the lowest incomes, the lowest credit scores overall, in the weakest financial position, and they would not be able to access a forward mortgage product because they don't have the income to do it. And so the reverse mortgage is their only option to allow them to age in place. And, sort of from in addition to the individual's point of view, from a taxpayer's point of view, it's also the most beneficial option because it's aging in place, even with some amount of care, it costs about a third as much as being in a nursing home or another type of facility. So, there's a huge policy reason to allow people to stay in place as well.
Mm-hmm. Great, thank you. And unfortunately, Nadia, I had a couple questions for you, but I'm afraid that we are quite out of time, and so I'm going to have to cut it short here on those questions. I apologize, but feel free to send me the questions that you have, and then if our presenters are okay with it, I will then forward those questions on to them. So I want to go ahead and thank everyone for joining us for the webinar today. Please remember that we did record this webinar. It will be posted on our websites, cfs.wisc.edu, as well as our cfsrdrc.wisc.edu website as well. Within 2 business days, it should be up on those sites. And then again, I'd like to thank you for joining us today, but then also please look forward to our next webinar, which will be October 9th. And I feel that it was, we had kind of the perfect segue into this next webinar, which is Nursing Home Care and the Impact of an ACA Program, a webinar overview of study findings and implications. Thanks so much again to Stephanie Moulton, Cecilia Leubel, Donald Hurin, Laurie Goodman, and Nadia Karamcheva for your presentations today. And I thank you to the audience for tuning in. Please enjoy the rest of your day.